Emerging markets really, obviously, very topical at the moment. You can just picking up a newspaper in the last 2 or 3 weeks, you would have probably more likely to seen the term submerging markets being used, and the focus recently has been more on the underperformance of markets like India and Indonesia. But really, this is sort of part of a sort of a story that's been going on for 2.5 years now. And in the first part of this presentation, I'm really going to sort of focus on, take a sort of a big picture view and focus really on whether now is a good time to sort of enter emerging markets or not. And then in the second part, we'll just touch on a couple of points about implementation choices, particularly about whether it's good to be passive or active in emerging markets. But just to kick off, this chart here plots the weight of emerging markets in the MSCI All Countries Index. So it's going back a couple of decades or so. So it's obviously been, quite a ride from 1% or so in 1989 up to 14% at its peak, or just under 14 in 2010, and then today, as of today, it's about 10.9%. So obviously, emerging markets have become a reasonably important part of global portfolios. And I suppose the question, as I said today, is whether it's now's an appropriate time to sort of top up. This next slide also does quite a good job of sort of explaining the story of the last few years. So in the early 2000s, the memory of the Asian crisis and the Russian default of '98 was very much in investors' minds. We then went through a period of sort of ample liquidity, and thanks once again to the low interest rates in the US, sort of combined cyclical upswing in the world, and flows into emerging markets were one of the main beneficiaries. And you can see this here from 2006, that equity flow, this is just equities, were ramped up. Over the last couple of years, on the back of sort of recent underperformance, you can see there's been a slight sort of pause in that trend. If this was a chart of emerging market bond flows, then you'd see a much more aggressive outflow in the recent past, and that's to some extent behind the currency weakness we've been seeing in the last few weeks. But the sort of the selection there on the right-hand side from the FT is a good summary, I think, of how most emerging market managers are sort of responding, which is that yes, growth is weaker than it was in the past, but it's still stronger than developed markets, and now's a good time to sort of buy. And the argument sort of normally, revolves around this sort of growth story, and you quite often see charts like this in emerging market presentations, and the argument's very simple. It's basically, well, here's the world, it's a big place, emerging markets are already a big part of that world, they're going to get bigger, so therefore buy. From a market cap perspective, I'm not sure if you can read the text there, but basically the point is on IMF projections, and basically it's quite easy to see about half of the world's market cap being in emerging markets within the next 2 decades. Although I should point out, because of free float restrictions, only about 31% of that is actually going to be available to investors. The question is whether that's sort of, is that enough of an argument to basically to say we need to raise our allocations to emerging markets? And you've seen, I'll explain this chart because you might not be able to read the text, but I mean, you've seen plenty of evidence now to suggest that GDP growth doesn't translate into faster or higher market returns. This chart here actually looks at market earnings growth, real earnings growth over time compared to real market performance. And even if you look at like for like, this is the market earnings growth, it's not the economy, you see there's not a very strong correlation at all. You've got countries on the right-hand side like Korea with very fast real earnings growth over the last 20 years, generating lower returns than markets like Russia, which actually have had negative real earnings growth. I mean, the correlation there is 11%, so it's virtually non-existent. And even if you knew with perfect foresight what was going to happen next year to earnings growth, there still isn't a great correlation between market performance and market return. So I think, the reason I'm sort of trying to bang on about, or the reason I'm sort of going on about this is that growth alone isn't a good enough reason. And one of the reasons, why is this a disconnect between growth and market performance? And part of the answer is sort of explained in this chart here. So on the left-hand side, the blue line is the cumulative earnings of emerging markets starting in the mid-90s, and then the orange line, or the red line, is the same cumulative earnings performance for developed markets. So there's about a 7% annualized gap between those two lines over that period. Whereas on the right-hand side is actually what we receive as equity investors. We receive earnings per share, and historically, due to share issuance and the like, equity investors have been diluted to the tune of about 10% per annum over the last sort of 15 or so years in emerging markets. That's about 5 times more than the dilution you would have experienced, say, in the US market. So right here you can start to see that if you're going to buy in emerging markets, you need to sort of focus on sort of more shareholder-friendly sort of companies rather than just going for the ones that are generating the higher growth. I think if faster growth alone is not a sufficient reason to buy emerging markets, and as I said, there's not a lot of evidence to suggest it is, valuations obviously matter, and the price associated with that growth is also really important. And this chart on the left here, I'll just explain what this is. It's just the relative valuation of emerging markets to developed markets over the last decade and a half or so, and on the right-hand side I put frontier markets for completeness, but Julie can deal with that in the next presentation. So you can see, like 15 years ago, as I mentioned earlier on, there was a great sort of buy opportunity in emerging markets. They were cheap, they were enjoying sort of structural improvements, a coordinated global upswing, corporate governance was improving, ample liquidity. It was a great sort of, there was a number of tailwinds behind the asset class. But on the eve of the financial crisis in 2008, they actually were trading at a premium to developed markets. That then unwound slightly in the GFC, and then in 2009. Partly sort of thanks to China, and partly thanks, as in stimulus package, and partly thanks to quantitative easing, you saw quite a strong rebound back to a premium again in 2010, and then really the wheels started to come off, since the end of 2010, the underperformance relative to developed markets is about 30% now. So it's quite substantial. Some of that's coming from currencies and some of that's coming from sort of market performance. If you compare that to something like the US market, which has been the beneficiary of the flight to quality, then the performance differential between the two is of the order of 50%. So you can see why this has been such a big theme for global equity managers over the last few years. The last 2.5 years, they've done a 50% spread. Given that most global equity managers are underweight an expensive US market and overweight cheaper emerging markets, it's been a sort of a massive headwind to global equity manager performance. So the question is, what is the right multiple? Should emerging markets sort of trade a premium or not? And we did hear many stories from sort of courageous managers only a few years ago saying that they should trade at a premium, faster growth. This is going back to those pie charts at the beginning again, and stronger fundamentals. And the market never saw it sort of quite as simple as that. So this chart here shows the volatility of emerging markets relative to developed markets, and once again I put in frontier markets for completeness. But there's always been a premium of between 30 and 50% volatility, or elevated volatility of between 30 and 50% in emerging markets relative to developed markets, and there is no evidence that that's actually declined in the recent past. And if anything, if you look at the last 6 months, you would see a volatility spike in emerging markets relative to developed. So the markets are not looking at emerging markets and saying, well, the fundamentals are better, I'm therefore going to treat you with sort of less volatility. That's not the case at all. And the reasons for that are probably about private sector credit expansion in a lot of these markets, which has led to sort of very unbalanced economies. So this chart here is just one of many I could have used just to highlight the sort of unbalanced nature of the Chinese economy, and that people, the bulls focus on low sovereign debt in emerging markets, but actually it's really a private sector problem. And the problem with a lot of these economies is they've got very concentrated economic structures. So Russia's an oil play, Taiwan's a sort of a tech play, and most of Latin America is sort of geared to commodity prices. And so and on top of that, you've also got this financing problem that isn't quite as severe as it was in the 90s or in the Latin America in the sort of in the 80s, but in a sense that a lot of these countries now have got higher foreign exchange reserves and more prepared to let their exchange rates float. The markets that have been in the firing line over the last few weeks have been those which have got the most reliance on external creditors. So in other words, those with current account deficits. So it's India, it's Indonesia, it's Turkey, it's South Africa, it's Brazil, and the currencies in all those countries are all down double digits this year alone. And then on top of that, you've got market underperformance as well in all those markets aside from South Africa. So you start to see that perhaps the risks aren't sort of as low as everyone sort of hoped. And on our sort of reckoning, it's difficult to know what an appropriate valuation is, but we would say something more like sort of 20 to 25% discount is appropriate given the elevated risks in many of these markets. Given that we're at 30 today, this probably is it's as good a time as any, I suppose, to sort of step in if you were thinking of raising your allocations from where you are at the moment. But I would sort of I don't think there's a very compelling sort of argument for more than a sort of a bounce really at the moment. So you might sort of think, well, why bother? If there is only like 5 to 10% upside from here, and then we're always going to be trading sort of slightly cheaper for a reason, then why bother investing in emerging markets? And Julie's presentation coming up has got some great slides in terms of the stock story, so I'll just sort of concentrate on a couple of themes. One is that you can still be quite optimistic on parts of emerging markets without actually being optimistic on the index necessarily performing well. So one thing I was going to focus on now is the sort of your implementation choices within emerging markets, particularly about whether you go passive or active. We're often asked whether we'd run a core or an index plus type strategy in emerging markets, or clients say, well, I could always buy an ETF. Why do I need to go active? So I think there's a couple of slides I'm just skipping over just because of time, but these pie charts here show the degree of concentration in the emerging market index as constructed by MSCI. So you've already got sort of quite a fragmented asset class, but within that asset class you've got sort of two sort of big themes. One is the concentration in sort of financials and resources. And obviously from an Australian perspective, you've already got that in your local market. So why would you want to double up by buying emerging markets? But also from a country point of view as well. 4 countries make up sort of nearly 60% of the index, and in frontier markets is even more concentrated with half the index in sort of financials. So you can start to see here that the more you can move away from sort of a concentrated sort of index like in a thematic sense, the more opportunity there is going to be to add value. Another reason for sort of not being passive is the fact that a quarter of the emerging markets index is actually made up of state-owned enterprises, about half of which are in China, and these are companies that generally enjoy some privileges, whether it's sort of beneficial, bank loans, or they've been gifted land or what have you, and they tend to work in monopolistic type industries. But there's also plenty of evidence academically to show that these companies are actually less efficient than the sort of similar private sector companies that are working in similar industries, similar areas. And you can see the performance there of Chinese SOEs over the recent past, and this is probably a structural decline. I don't think that's a great valuation opportunity, because China is one of the few countries which is starting to liberalise its state-owned enterprises. And then I would say, you're all now familiar with the idea of smart beta strategies and the proliferation in non-cap products over the last 10 years. They work even more effectively in emerging markets. So as a starting point for active management, being non-cap weighted is really important. So this is MSCI data, so I haven't you can't accuse me of fiddling the numbers, but there is a mid-cap effect in the sense that a large cap underperform in the universe, but even the most naive of a non-cap weighted strategy, which is the equal weighted index, you can see that that's outperformed the cap weighted index by about 2% on average on an annualized basis over the last decade or so. So it's I think basically my point is that starting from a non-cap weighted or starting off an active process without any real recognition of the index is probably even more appropriate in emerging markets than it is in developed markets. I'm sure Julie would agree. And then, given the time, the last point I wanted to focus on, and maybe we'll come back to some of the other issues in the questions, is this sort of idea that country risk dominates in emerging markets, and that's certainly the case. This chart here is actually a month out of date now because we prepared this 3 or 4 weeks ago. But if you rolled it up to the end of August, you'd see the spread in performance between the deficit countries, which are pretty much concentrated in Latin America and parts of EMEA, compared to the Asian countries, which are generally enjoying current account surpluses, China and Taiwan in particular. The spread in performance between those markets this year alone is of the order of 20% or so, but a large part of that, about half of that, is coming just purely from currency movement. So for a long time, I think everyone was prepared to ride the carry trade in emerging markets, leave currencies unhedged. There is obviously some correlation with the Australian dollar, particularly in the commodity currencies from the Latin American currencies, like the Brazilian real in particular. So perhaps there's less need to hedge than there is, say, from if you was a US investor. But it just raises the question about, can you forecast this? We've known for a long time about the elevated risks in markets like Turkey and India and South Africa, and we've been hedging the currency risks in our portfolios, but we just didn't know what the catalyst was going to be. So in South Africa, the catalyst for the rand weakness was political unrest social unrest and riots around some of the mining companies. Recently, the Fed tapering has been the catalyst for the sell-off in India and Indonesia. So you never know what the catalyst is going to be. So just because these effects are important doesn't mean to say you can forecast them. So it obviously has issues for how you build your portfolios, whether you're a top-down investor trying to get the macro right, or whether you're a bottom-up and manage those associated country risks that are implicit in your portfolio. Our preference is the latter. So I'm going to leave it there, and hopefully we'll get a bit of time to come back to some of those other issues in the questions. But so just summarise by saying that it's been a wake-up call, the underperformance of the last 2.5 years. I think it's healthy in the sense that investors are now probably more accurately pricing the risks of investing in emerging markets. It's now a good time to enter. It doesn't seem a bad time, but the upside is probably not on the same scale as what we observed in the early 2000s and subsequent to the financial crisis. But the most appropriate way to invest in emerging markets is by being fully active. If you're going to, it's a stock picker's dream, really. The amount of volatility you have within the market and the breadth of opportunity is huge compared to what you'd see, say, in a market like the US. And you observe this by just looking at manager performance in emerging markets relative to those in developed markets. That you're generally extracting more alpha. So I think that's the real key theme I wanted to leave you with, and as I said, hopefully we'll get a chance to come back to some of those other issues and questions.
So today I'm going to talk a little bit about frontier markets, and David has already spoken a little bit about the emerging market story, so I'm not going to talk too much about that. But I will come back to the growth story, in particular what is underpinning, in our view, some of the most exciting opportunities in investing in frontier markets. And this really comes down to some of the shifts that we've seen in frontier markets with respect to actually the working population, the consumer story, the growth in the middle class, the population booms that we've seen, and increased employment as a result of that in frontier markets, much like what we saw in emerging markets 20 years ago. And that's really, for us, one of the most exciting parts of participating in that sort of cycle in frontier markets. But if there's one thing that I would like for you to take away today when it comes to investing in frontier market equities, is that it is still very much a long-term play, just like emerging markets were 20 or so years ago. So why frontier markets? And I am going to address a little bit, actually, this growth story, because it is still very much a part of what we're seeing on the ground. The first thing is from an economic point of view. Frontier markets have some of the highest economic growth changes that we're seeing on the ground relative to other economies in the world. That's what really we see on the right-hand side. The frontier markets do include about 1 billion people, 15% of the world's population, and represent over half of the world's oil and gas reserves. These are pretty substantial economies and also scalable economies when it comes to growth. The implications behind that is, as these economies continue to evolve, as they start opening up, as they start becoming more regulated, as a result of that, we're going to see a lot more in terms of participation from the consumer in these economies going forward, and that represents a huge untapped market for us. The Middle East in particular is one of those areas, and I'll talk a little bit more about that in terms of where obviously the commodity wealth from the oil revenues is being channeled to the local population, that's driving domestic consumption, that's driving consumer growth, and it's an area that we think is going to continue to evolve over the next 10 to 15 years. The reasons why we think it's an unprecedented source of alpha is simply because, frankly, frontier markets are still very misunderstood. One of the things I constantly come across, I'm talking to investors about frontier markets, is that 60%, if not more, of the investment opportunities in global frontier are in the Middle East. And well, of course, these days, the moment you start talking about the Middle East and Syria and everything else, people sort of back off. But the reality is there's a really big misunderstanding between geopolitical risk in the Middle East and investment risk in the Middle East, and I hope to talk a little bit more about that. And because there's still little coverage by sell side, by the brokers, and even to some degree the press, even though that's starting to grow a little bit more, there's a huge amount of opportunities of companies that are trading in frontier markets that are simply misunderstood because they're being misassociated in terms of the markets that they're in, whether it's the UAE, Qatar, Saudi Arabia, or Nigeria, or Kenya, or anywhere else, where there's actually a really ample, really well-run businesses, high-quality businesses that are trading at very low multiples simply because it happened to be in the wrong place according to investor perceptions. The environment, of course, has been quite different this year, and I think that's why we've seen a lot of interest in frontier markets this year and even in the back end of last year. Emerging markets, as David has suggested, has certainly disappointed this year in terms of returns. Frontier markets are one of the highest return equity markets in the world right now. They're actually surpassing the S&P 500. They're surpassing many of the developed market equities this year, and this is again in US dollar terms. But even so, as a result of that, it's true that valuations in frontier markets, as a result, look like they might be almost the same as emerging markets because of the difference in returns we've seen. But if you dig a little bit deeper, you will find that actually companies within frontier markets are trading at a huge discount or spread across different sectors and different countries, depending on where you look in that space. And there's one thing I want to actually touch on when it comes to using indexers, when it comes to frontier investing. It is still very much a very fractured index, and that, for example, an MSCI Frontier Markets Index only includes 4 markets in Africa as part of their index, whereas we've recognized over 15 markets on the continent outside of South Africa that we think are worth investing in. And I'll touch on the liquidity question, which comes up very often in a moment. But one of the single key, most important, attractive aspects of investing in frontier markets is the low correlation. We talked a little bit about this a few minutes ago. But emerging markets have indeed become increasingly correlated with developed markets. Why? Because a lot of companies in emerging markets are effectively global. If you think about Samsung, Kia, Hyundai, TSMC, these are global businesses that generate less than 20% of the revenues at home. Most of these companies are effectively global exporters, that are tied to the growth in China, tied to the growth in Europe, in the US, in Australia, everywhere around the world except at home. Whereas frontier market companies are still very much a domestic play. These are companies that are still building out their infrastructure, their operations, their distribution networks, their products for the local consumer, that are benefiting from local infrastructure plays, developments by the government, and therefore, whatever happens with QE tapering, Ghana really doesn't care. They don't have to care, because most of what they're doing is happening on the ground at home and is being fueled by their own domestic growth story. So that's why for us, the frontier markets have not only offered some very attractive returns so far this year, but they've done so in a very uncorrelated way. And even within frontier markets, different markets, whether Saudi Arabia, Ghana, Vietnam, are uncorrelated with each other. So that gives a very attractive opportunity to really diversify the overall exposure to the emerging market and frontier market space by including this sort of strategy in a portfolio. So let me talk about the Middle East, because certainly that's the first thing that people come across when talking about global frontier is, well, it has a lot of Middle East in there, and I'm not entirely sure this is a good place to be right now, especially with the news that we've seen over the last few weeks. So I'll talk a little bit about why the Middle East is something you really should take a second look at. And when I talk about the Middle East, I also include Saudi Arabia, which again does not feature in the MSCI Frontier Index. Why? Because Saudi Arabia is one of those markets that does not allow direct foreign access to equities, so the only way you can buy into that market is through derivatives known as P notes or promissory notes. That being said, the volume in Saudi Arabia is the same as Russia. It's huge. It's a very liquid market. And therefore, there's a lot of opportunities to trade, to find liquidity, to look for opportunities there in terms of investing without having the sort of issues or concerns that you might have investing, for example, in Zambia, in Africa. So the thing about the Middle East that has been a key feature for the last few years is how the Arab Spring has played out in terms of overall consumer growth, overall political sort of policies that are happening on the ground. The key one being, of course, and again I'll touch on Saudi Arabia. Saudi Arabia has a population of about 30 million people, of which 9 million are considered part of the working force, working age. Of that population, about 70% of that population is less than 30 years old. About 50% is less than 25 years old. It is a very young population. What the government did over the last few years is they introduced policies that, one, introduced an employment benefit to the local nationals. And the second one is they gave incentives to local businesses to employ local nationals as part of the overall growth expansion. As a result of that, 1.6 million people in Saudi Arabia found themselves with new money in their pockets. And that is driving a consumer boom that has nothing to do with what's going on in Iran or in Syria or Lebanon or Israel. And that is what's driving a lot of this economic growth that we're seeing on the ground. The same thing is happening in the UAE and in Qatar. The other question I get asked is the corporate governance. And here what we have is a chart that shows the actual ranking of the GCC countries, so the Gulf community countries, relative to some of the biggest markets in emerging markets. A higher score means higher corporate governance. And one of the things that we have learned in investing in some of these markets, especially in the Middle East, is that many of these countries actually have fairly decent corporate governance practices. The one that has a little bit less, actually, in the GCC is actually Kuwait. Kuwait has a far more trading culture relative as opposed to an institutional buyer's market. Saudi Arabia is a very retail-driven market. Many of the companies that are listing in Saudi Arabia come from either sponsored through government or quasi-government firms, so they used to be state-owned enterprises, or they're companies that have listed that used to belong to well-established families whose reputation is very important. And therefore, there's a culture of there's a low wrongdoing, if you will, and there's a culture of actually treating shareholders right. And Bahrain, Oman are very institutional in nature. They understand the importance of foreign investment, and therefore they tend to treat their shareholders fairly well, and the minority shareholders fairly well. So as a result of that, actually, we are pretty comfortable investing in these markets despite what the press will want you to think. And therefore, this is an area that's worth considering as part of the overall investment into this space. So in terms of what we mean about risk and in terms about opportunity, so in terms of Middle East, I'll just address the issues right on in terms of what people think about in terms of conflict. So conflict has been a big issue in the region over the last few years. The currency risk, is there going to be a risk of a devaluation? What about capital controls? Will I be able to repatriate the foreign currency into other currencies? Will I lose my assets if they get nationalized, if there's a big conflict or a seizure by the government? And what about liquidity? What if it dries up? Well, the reality is many of the currencies in the Middle East are actually pegged to the US dollar. So when it comes to actually having currency risk, it's more related to the US dollar than it is actually related to the local currency. The economies as a whole in the Middle East are actually running current account surpluses. I mean, these are some of the most wealthy nations in the world as a result of the oil revenues that they generate. The governments have much more incentive today to fix some of these social problems that they've had in the past than they haven't before, and they are addressing those, like Saudi Arabia, for example. They are able to drive much of their economic growth through the consumer spending. They're able to, local retail investors are becoming increasing participants in the market that's driving liquidity. And the dislocations that we've seen in the market are certainly not very well seen by local governments. So they have a real incentive to not only keep the market stable, but also support them during times of crisis. And that has helped these markets flourish as a result of that. So these are some of just the examples where we've shown in terms of how the markets have reacted to conflicts in the past. The most important one is the 2003 invasion of Iraq. When that happened, the markets dropped quite significantly. That was in just on the 3rd of September, around that time frame in 2003. But since then, the markets have recovered very sharply once things calmed down. And the second drop you see there is some of the other political issues that we've dealt with since then. The same thing we've seen, of course, in the Arab Spring in Saudi Arabia on the left-hand side is that the big sort of initial protests that happened in 2011 and the subsequent market correction. Muwassat, for those of you who don't know, is ironically a hospital listed sort of private medical services company, and certainly during that time it has flourished substantially even after the conflicts had abated. And it is an area where you still, even if there's conflict, this is what creates the opportunities. And if you're willing to see kind of through past the smoke and the noise and take a longer term view, the returns can be attractive in these markets. But certainly what most people like to talk about when they talk about frontier markets by far and large is about Africa. This has been a destination for investors now, increasingly so this year. This is the kind of story that gets covered in the press when thinking about multinational companies that are expanding their businesses there, that are showing a strong revenue growth. Africa is on a major sort of growth expansion. If you think about Africa, where it was at the end of the Cold War, there were only 3 functioning democracies. Today there are 25 functioning democracies. The quality of life is improving dramatically in terms of the health. The malaria is down, HIV infections are down, life expectancy is up, more children are going to school, so there's a knowledge economy that's currently incubating and growing on the continent. As a result of that, we're also seeing a tremendous amount of foreign direct investment coming into the continent. It's doubled over the last 10 years, and it continues to grow spectacularly relative to other markets in the world. This is a fantastic, in our view, support and structure from which, again, this growth that we're talking about can continue to be fueled, to continue to expand over the next 10 to 15 years. And again, just like in the Middle East, there's a very young population in Africa. They account for more than 40% of the global population by 2030, we think, and over half of Africa's population is still under 20 years old. So there's still a big sort of working class that's coming through into Africa. The consumer-facing industries alone, and this is why the multinationals are moving into this space, is expected to grow by $400 billion over the next 7 to 8 years. This is a massive market market for these companies, and there's a lot of businesses on the ground who get that. Of course, there are others that don't, and corporate governance is an issue that we continue to follow very closely, but the consumer market and the consumer growth that we're seeing on the ground there is probably one of the strongest we've seen in any other part of the world. It's surpassing China, surpassing Asia, and other parts, even the Middle East. The reason why we feel very comfortable and confident of investing in this space is simply because, as a result of some of these democracies coming through, and also the stable and smooth transitions of power now that we've seen over the years, Kenya is an example of this. Even though there have been protests recently with Mr. Kenyatta winning the presidency, the last time Kenya had an election, which was 5 years ago, over 10,000 people died. This time, less than 100 people died, which is still not great, but it does show a remarkable improvement to some of the things that are actually getting a little bit better than where they were 5 years ago. Things are stabilizing, but obviously just have a way to go. And again, that's why you have to have this long-term view. But one of the key things about having a stable democracy and a stable government is that they have then the power, the structure, the confidence, and the credibility to introduce reforms and regulations which help fuel investor confidence in these markets. And that's one of the things that we've been following very closely for the last 20 years. But of course, there are still skeptics who say, well, rather than invest locally, why don't I just invest in the global company, the multinational that has its business expansion going on in Africa? I'd rather do that because it feels a whole lot safer. Well, that's great, because one of the things that we all know is that if you don't take any risk, you certainly won't get any reward. That's exactly what goes on in some of these markets. These are examples of consumer companies, many of those I'm sure you'll recognize, which have businesses on the ground. The gray lines is actually not the horizontal axis of the chart. It's actually the currency return of the parent company, and the blue line in the same currency is the return of its local subsidiary on the ground in Africa. Now, I do notice that Unilever Ghana is actually presented twice for those of you who are still able to stay with us. The actual table on the right-hand side, it says Unilever Ghana, is actually Sonatel. The chart for that is Sonatel. Its parent company is France Telecom, and these are basically the returns in the local currency of the parent company and that of its actual subsidiary in the same parent company returns. What you'll find here is that in order to take advantage of the local opportunity, you have to invest locally. The global investment idea simply doesn't hold true. Why? Because these companies like Unilever, for example, they're still trading in Europe. They still generate a vast amount of revenues overseas in developed markets, and they still have to deal with the confidence of the market in which they're listed, whether it's the UK, whether it's Europe, for example. It hasn't exactly been a bed of confidence the last few years, whereas in Ghana, Nigeria, whether it's in Senegal or anywhere else, they've just continued to thrive in their environment fueled by the strong growth and the strong revenues behind that. So finally, in terms of frontier Africa and investing, there's clearly a lot of risk that we need to be cognizant of, and I'll touch on these before finishing up. But basically, the opportunities, again, within frontier Africa are very simple. There's a strong amount of communication, there's a strong amount of development going on the continent. And we were so surprised when we looked at Zimbabwe, for example, as a market, and realized that Zimbabwe has a nearly 100% penetration rate when it comes to mobile phone use. Almost everyone there has a mobile phone. Nigeria is growing on the whole mobile network boom that we've seen. In fact, one of the banks there that we invest in is actually growing its business through cell phones rather than through branches. And this is a common theme in Africa. But certainly there's also quite a bit of risk that we have to be aware of, and you really have to do your homework, and I think this is where active management can really help. It is still very much a research-intensive exercise. Now, investing in Africa requires a tremendous amount of due diligence. It does require visiting factories on the ground, and if companies refuse to let you see them, chances are the factory probably doesn't exist. There's also situations about disclosure. The palm oil producer, which has just launched this whole new field of crops, may forget to disclose that actually its land is below the table the water table level, so when the first time it rains, everything gets flooded. They forget to mention that part. So there's certainly areas in the market where you really have to be careful about what you're investing in, but certainly if you do your homework and you do your due diligence, it is very much possible to find companies that are trading at very attractive prices, are able to deliver not only high earnings growth, which is important, but not the only story certainly, but also high dividends. Many of the companies that we've been looking at over the last 20 years in Africa are generating dividends of 5, 6, 7% on an annual basis, and have been doing so for the last 10 to 15 years. So these are companies that not only offer lower risk, lower correlation, and higher potential growth, but they also offer very attractive levels of income. That for us is very exciting. The last but not least important, certainly, aspect of risk is, of course, liquidity. And certainly many of these markets do have low liquidity. They're still fairly new as markets, or their foreign investment is still fairly limited, but it is growing. So again, you have to take a long-term view. And I think one of the questions that came up was about volatility in frontier markets relative to developed markets. Part of that is driven by, for example, the lower volumes that we see in frontier markets. So certainly they won't trade as much. So when people overreact sometimes in emerging markets and sell off quite quickly, they won't do so necessarily in frontier markets. There's also recognition that because there's this QE tapering, there's all this currency risk going on in emerging markets and to some degree even developed markets, there isn't so much the case actually in frontier markets. So investors have a tendency to hold back. They hang on to it, they ride it through for the long term, and they tend to slowly invest or divest over time, as markets continue to recover. So with that, I would like to I could certainly answer some of the questions that came up certainly that have come up. One of the questions, for example, is, are institutional investors putting pressure on Middle East companies to improve the treatment, training, and education of women? The answer is actually yes. We've seen that. In fact, one of the things in Saudi Arabia that we've seen as a result of some of the new employment incentives that they've actually put in place, about 1 million people now are on this employment drive in Saudi Arabia, 85% of which are women. So it's a huge development that we're seeing. Women are strongly entering the workforce in the Middle East, and if Saudi Arabia is any indication of what can happen, certainly it's been expanding all over the region. So it's an area that, of course, is very positive. Frankly, women are bigger spenders than men are when it comes to consumer expenditures. We've seen that over the history of emerging markets, developed markets, etc. So we do know that they can drive some of that. So it is an area that we continue to find. We are not activists as an investment management house. We certainly look at companies and how they actually support their workforce, and also how they have employment practices and how they treat minority shareholders. But we certainly follow some of that. It's always for us a positive development. The other question is, how do we invest in shares in the Middle East? Well, frankly, many of the markets are open to foreign investment. The only one that tends to be the big hiccup is actually Saudi Arabia. But the biggest issue really in terms of investing in the Middle East has to do more with opening a custody account, frankly, than it has to do with actually trading. And we use many local partners as well as global banks to trade in these markets. We've been doing so fairly easily for the last 10 years. It's an area that we have fairly limited issues with, but certainly Saudi Arabia is probably the one area that tends to be the harder one to invest in, because again, it has no direct access to those particular markets.